Hello, everybody. This is Mike Hanghold, and thank you for joining us today. With me today is Doug Johnson, as usual. Doug, of course, is one of the partners here at HCM, and he chairs our investment committee. So he's the answer man when it comes to the portfolios. Just briefly, the administrative items to talk about. If you have a question, there is a Q&A button at the bottom of your screen. If it's not there, if you go down and hover it, it should appear. If you would like copies of the slides that we're going to go through, you can request those and we'll send those out to you. And finally, we should have a replay of the event up on our website with a little bit of luck by midday tomorrow. The main theme of our discussion today is going to be recovery. So, we've been talking about pandemics and things now for a year, and finally, with the vaccines rolling out, we get to talk about recovery. So we're going to do that, and we're going to talk about the signs that we see in sort of amongst the population and as well as in the markets. And one of the surest signs that there is that recovery is on its way is the fact that people want to travel again. And apparently cruises are a popular item among HCM clients, because I've had at least, if not more, at least half a dozen people ask me in the last couple of weeks if it's safe to travel again and if booking a cruise is a good idea. So, the first part of the question goes way beyond my pay grade, whether it's safe to travel again. But I did do a little bit of homework on the subject, and the simplest thing to do is to go to the CDC's website, which I did, and I double checked this again this morning. And the CDC is suggesting that people stay away from cruises, both ocean cruises and the popular European river cruises. The reasons given are all the ones you would expect, primarily because cruise ships are floating petri dishes. That's not exactly the quote from the CDC's website, but it's not far off. So is it a good idea if you were getting ready to set sail today? Probably not. Looking into the future, let's talk about just a couple of other items. So if the whole CDC thing doesn't bother you and you're not particularly concerned with the health issues on board, the first thing to do is make sure that you have two good types of insurance. The first is obviously medical insurance that has good travel components, will take care of you wherever you are, and make sure that it covers COVID. Not all policies do. The second is a good travel policy. So these are expensive. People oftentimes turn them down thinking, it's just money I don't need to spend. However, particularly in the cruise industry, there have been, the cruise companies have been stressed financially as a result of the shutdown and their huge capital costs they have to maintain, whether they're sailing or not. So they have a lot of financial problems right now. So you want to make sure that if something happens, and either because of these virus variants or you are simply uncomfortable sailing at the last minute, that you have a way out and you're not going to be penalized financially. I read an article just recently about Viking cruises. Viking, of course, is a premier cruise line in Europe. They have both ocean cruises and they, of course, became popular with their river cruises. They needed to raise capital and they had to go into the junk bond market to do so. The rates that their bonds were selling at were approximately a 15% interest rate. So it tells you that's a high risk credit, and those risks are pervasive throughout the cruise industry. So make sure you have good coverage there. In terms of when when cruises are going to start. They're scheduled to begin again just in a couple of weeks. March 1st is when business opens up. However, a number of the cruise lines, especially the most popular ones, names you would recognize, have elected to push that back weeks or even months. Some of them are by the cruise line itself, and some are by individual ships. But the point is, it is starting. When the cruises do start, it's expected that the ships will be about 50% occupied. So they're using advanced bookings, obviously, to control that. And the expectation is that those the population on board will grow to about 90% by the end of this year, and by the beginning of 2022, we will have, of course, probably chronically overbooked cruise ships, assuming that we don't have additional health issues, because people are going to be itching to get back out there. So what are some of the safety precautions? Well, many of them are the ones you would expect. They're going to be the same on boat as they are on land. Passengers will be required to complete health screening questionnaires before they go on board. And this is the one that took me a little bit by surprise. Passengers will be required to take a PCR test immediately before boarding. So for passengers who were, especially in Europe, or if you travel with the cruise company ahead of time, and you're staying in a hotel the night before your cruise, you'll be tested in the hotel. Otherwise, you'll be tested shipside, and the results of these tests can take 3 or 4 hours to come back. So it's going to be sort of a confused delay period while these results are obtained. Same thing when you're disembarking, you'll take the same type of test. You'll also have to be aware and respect the policies regarding quarantine for the countries that you'll be going to. So that's an issue that everybody's going to have to pay attention to. Obviously, the boats all are going to have, early on anywhere, all going to have masking requirements in all of the public areas, hallways. Restaurants, tables will be pushed further apart so people can respect distancing, all the regular things with hand sanitizing, contact-less activities to the extent that it's possible will be done. And for the first part of the year, at least, up through October, I believe, no U.S. cruises are allowed to last more than 7 days. So those are some of the differences that we were able to dig up between what people would have been accustomed to in the good old days. Also, Congress passed a law called the Cruise Passenger Protection Act. It had a couple of requirements. These are not particularly disruptive. However, in fact, they're good changes. All ships, I had read in one place where it was boats with 250 passengers. Others seem to be all ships, but have to have a licensed physician on board who is trained in viruses, COVID, those sorts of things. And also video cameras are going to be installed in all public areas so that the monitoring of people's mask wearing and so forth can be done effectively. So it's going to be a different kind of environment, at least for the balance of this year until everything gets figured out. There will obviously be a number of other specifics that the industry will figure out as time goes on, but that's sort of an outline of what we were able to come up with. So now Doug has a variety of observations and statistics and market observations about this sort of recovery concept and where we're going from here, and potentially whether or not we're getting ready to play a game of musical chairs in the market. So, Doug. You're on.
Yes, thank you. So if you've been listening to these webinars or kind of keeping up with our communications recently, we've touched on several themes that we believe will be additive to portfolios going forward. And one of these, Mike mentioned earlier, is this general idea of reflation. And we've talked a lot about how we get there. And a big part of that is kind of getting the COVID situation, I don't know about under control, because I'm not sure that it will ever be completely under control, but getting those trends to move in the right direction. So one of the main aspects of that is the idea of getting a vaccination out to the public that has high efficacy and is able to, I guess, be replicated in large quantities. So this is a chart that just came out recently, but shows from the beginning of all this, the total recorded cases in the blue line, and then the total doses of vaccinations administered in the red line. So for the first time back in early February, we had the total number of doses of vaccinations eclipse the number of total cases recorded. So I think, from a standpoint of, are we moving in the right direction in terms of trying to control the best we can the COVID situation? I think this is a significant milestone towards that, and hopefully those numbers are only going to improve as we move forward. Now, as we look at a variety of different measures, both going back 90 days on the top section and since the beginning on the bottom, we can see that testing has become extremely robust. So in the beginning of this, it was very hard to get a test. Now, if you can get tested fairly quickly by contacting your doctor, even they have rapid testing. But what's striking about this now is you see the number of new cases, both over the last 90 days and then since this started back in March. So we've seen a significant reduction in new cases, almost a 50% reduction over the past, I'd say, 35, 40 days. And then if you compare that to what we've seen since the beginning of this, it almost looks like a free fall back to levels that we saw kind of at the peak of that second wave in the summertime. So that is a step in the right direction. Part of that could be a result of increased vaccinations. Some of it could be just coming out of the holiday swing where travel is dissipated. But for whatever the reason, we're certainly moving in the right direction. Looking at hospitalizations, the same trend is continuing. Right around that peak in early January, you've seen a significant drop off in hospitalizations, both over the past 90 days and since the beginning of the episode. And then finally, the death count is starting to roll over. Usually deaths trail hospitalizations by, I believe, 2 or 3 weeks. So as this trend of hospitalizations continues to move down, we expect the death tolls to decrease as well. So getting this situation moving in the right direction is a big, big step in order to allow people to feel the need to get out in the economy, spend money, do things that in the past and during lockdowns maybe were not possible. So as we've seen that, how does that relate to the returns and some of the asset classes that we've talked about? Well, here's a chart that goes back approximately 6 months. And if you've listened or seen the communications that we've put out, 3 of the main themes that we've focused on in terms of asset class has been value specifically, small cap, and then international. So this shows the return of comparable ETFs back 6 months. And as we pointed out, really the inflection point in this kind of trade, if you want to call it that, or reflation theme, took place right around the time of the election. You had a split government initially seen as a good thing. The split government lasted about 2 months, and now we have full Democratic control of the government, but nonetheless seen as very stimulus friendly. And that, right now, I think we have a $1.9 trillion package that's on the table. They're working out the details of that. But as we look at the returns here, You have the Russell 2000 in orange, so that represents small cap. Then below that, you have the value factor ETF in purple, international ETF in blue, and then you have the market in green. So since that inflection point of the election, we've seen a lot of the themes that we've been touching on and that we've been positioning in portfolios performing well and adding a tailwind to the strategy. So far, so good. Where do we go next? Now, these charts here are kind of I was joking with Mike earlier, I call them kind of a Rorschach test of economic data, because I think you can look at them and see different things. The first one is a measure of TSA checkpoint travel numbers, and it's a 7-day average. And then the dotted gray line is a percent of the last year's measure. So if you look at the blue line, that is 2019 to 2020. Okay, so think all the way back pre-COVID. So numbers, very steady, up right around 2.4 million. And that's a significant number. So we look at the red line, we see that drop off during COVID, obviously almost close to nothing. And then we've had a slow grind back and then a little bit of a plateau. Obviously, you've got a spike during November, Thanksgiving, and then Christmas. But now you're starting to see a little bit of an uptick as well. And you're starting to see the percentage of that number move up. So again, some may look at this and say, wow, we haven't recovered. We're still not close. I think that's one way to approach it. But I think the other thing is there's still a lot of slack that can be added here. There's still a large gap from kind of optimal capacity, so to speak. And as we relate this to COVID and the idea that vaccinations will continue, in case counts will continue to move lower, we will start to see travel pick up. You will start to see things like people go out to restaurants again. You hopefully will see things like people staying in hotels again. All the things that before I think were taken for granted as kind of an engine of the economy, so to speak. Now we'll have the ability to fill that gap and begin to fuel growth. Here is a similar chart here. This is sourced from an app called OpenTable, which you can go on and make dinner reservations. And this breaks it out by state. Now, this is kind of clustered all over the place. And I think part of that is that different states had different rules in terms of dining, both indoor and outdoor. So you're getting kind of a big divergence in patterns here. But nonetheless, you're still quite a ways away from where you were when all this started. So restaurant industry, travel industry, there's still a lot of slack there. And then lastly, we mentioned hotel occupancy. So again, back in, the blue line represents 2000 to 2020. So a fairly long time frame there. The dotted line shows 2019, which was the worst, the previous worst year since the Great Depression for hotel occupancy rate. And then you have 2020, which obviously was the COVID year, and you can see the large dip. And then that red line right there is 2021. So we're still, well below capacity in those areas. And we think as things begin to open up, that these trends will continue to move higher, and we can see that kind of as a multiplier effect in the economy, so to speak, and to bring some of these cyclical sectors back into focus. Now, one concern that's taken place with all this possible stimulus is the idea of inflation coming back with a vengeance. So on the next slide, we'll touch on the rate aspect of it. But in order to have inflation, you need to have too many dollars chasing too few goods. So you need a lot of money, a lot of money in the system, but you also need something called velocity of money. So how many times is a dollar changing hands, so to speak? Now, this chart goes all the way back to 1960, and what it shows is, I apologize, my laser pointer is giving me a little bit of an issue here, so bear with me, just kind of describing these. So the velocity is the blue line, and it peaked, right around 1995, 1996, 1997, and then since that point has slowly worked its way down, almost crashing, so to speak, at the beginning of the COVID situation. Meanwhile, M1, the money stock, has grown almost exponentially and has absolutely exploded during the COVID crisis as the Fed has just flushed the system with liquidity. So when we look at this massive gap there is a huge amount of money sloshing around in the system. Yet for whatever reason, we haven't been able to get the velocity of money to increase. So when you look at that large gap there, if that M2 can finally figure out a way to catch fire, so to speak, we could really see the beginning of some inflationary pressures throughout the economy. And many argue that you're already seeing them in certain places, asset prices, real estate prices, food prices, things like that. But the CPI, or the inflation rate, has stayed low for a significant amount of time. So, as we see stimulus plans with money going directly into consumers' hands, maybe that's the start of seeing an M2 or a velocity number increase, and we start to see some significant inflationary pressures. Now,
Hey,
with
Doug,
that, yes,
can you just tick back for a second?
sure.
So I think that I guess I'm leading up to a question, but
Okay.
so the red line shows the money that's slopping around in the system,
Mm-hmm.
and we're about to add $2 trillion to that. Not necessarily going into banks, but we're about to
Sure.
put more money into the system.
Mm-hmm.
And the blue line basically says, this is a bit of an overstatement, nobody really wants it. Is that somewhat fair?
I think you could term it that way. I think another way to think about it is, as money has tried to find homes, and literally and figuratively, you think about when you purchase a house. So the money goes in and then it just kind of stays there. So that is kind of a dead end in terms of velocity, so to speak. And in the same way that money goes into a portfolio, and unless you're actively doing things there, taking it out and then spitting it into the economy, it kind of stops, so to speak. So I think that a lot of the money that we've seen go into the system has found its way into things like real estate and equities, and we've seen asset prices go up. But I think as the economy begins to go open back up and we see goods and services become available again, I think we can start to see that flow of money going into places other than just assets, and they can actually go into goods and services, to where I buy something from a small business owner down the street, he takes that money and buys something from somebody else, and so on and so forth.
Yeah, and we talk about inflation. It's also the CPI basket of goods. Some would argue is a little outdated in terms of the things they measure. It's interesting. I saw a statistic just earlier this afternoon. I'm going to get this somewhat wrong, but the point will be clear, that lumber in building a house, it now costs, I guess, $1,000 for 1,000 board feet of lumber for a house, and that's the most expensive it's ever been in history.
Yeah.
And anybody who's bought a 2x4 recently that used to buy them for $2 and now buys them for $8 can see that there's plenty of inflation in the system. It just doesn't happen to be in the things that are being measured here. And partially, to some extent, we import deflation from around the globe through inexpensive labor from other countries. And that's had a massive impact on us. For a lot of this chart that you see running down is
Yeah, no, and I saw that as well. So you are seeing pockets of inflation, certainly in areas of the market. It just may not be in the place that is measured by the Fed and CPI.
right.
So one place you are starting to see it in the marketplace is with rates. So you've got this going back 5 years. You have the purple line on the very bottom, which is the 2-year Treasury, which basically is the rate that the Fed controls. And then you have the orange line, which is the 10-year Treasury rate, which the Fed does not directly control. And then you have the blue line below it, which is the spread between the 10 and the 2-year, or also called the yield curve. And then the green line is a kind of a forward inflation expectation rate that's derived from the market. So really, since the beginning of the COVID crisis, you start to see rates and inflation expectations slowly moving up. And then over the past few weeks, significantly, you now have the 10-year Treasury at almost 1.3%. And then while the 2-year rate has stayed fairly low, and you have inflation expectations starting to move up. So we've talked a little bit about fixed income and adjusting fixed income allocations and trying to add some positions in there that are not as rate sensitive to take some of the interest rate risk out of the fixed income side of the portfolio. And I think you also run the risk of, if inflation runs too hot and rates move too fast, it could upset the market a little bit in terms of how things are evaluated. Specifically on the growth side, I think that the growth in tech assets would certainly be more sensitive to an interest rate moving higher. So, if we start to see those things kind of catch fire, so to speak, it wouldn't be unusual to see rates continue to move higher, and in some instances almost put the Fed's feet to the fire in terms of trying to raise rates to quell that if they need to. So we've had a lot of questions and comments about speculation and kind of risk taking in the market right now. So I want to go through a few slides that kind of confirm that. Here you have a panic euphoria model from Citigroup, which it's hard to see because it almost goes off the chart here. But that red line with the question marks shows that the euphoria level is almost historic, going back to at least 1987. The one on the right, you have kind of a net percentage of investors who are taking higher than normal risk levels. And that's touched a record high going back to 2001. Here is charts showing that penny stock volume has exploded higher over the past year, in addition to total options volume, which has moved up significantly, while SPY or S&P 500 volume has stayed rare, pretty much in normal range, so to speak, after some increased volume at the end of 2019. And then here is, you see the word mania on here, but this chart is kind of self-explanatory here. This is small trader call buying volume. So call options are basically just leverage bets on positions to increase in value. And when we think of small trader, they're buying in lots that are below a certain number, maybe 5 or 10 contracts. But you can see that since the pandemic started, you've had this absolute explosion in speculation through options. And I'm sure everybody followed the GameStop situation. And this was a portion of that. But the option activity there is absolutely unprecedented. And then finally, I think, this chart does a good job of kind of showing the sign of the times, so to speak. So this is the Goldman Sachs non-profitable technology index. So it's just a basket of US listed companies that they say are in the innovation industries that are optimized for liquidity and weighted with nothing greater than a 4.65% weighting. So you can see this goes all the way back to 2014, pretty innocuous, up to right at the end of 2020, and it just absolutely explodes higher, almost at an absurd rate. Seeing this kind of, it almost looks like a penny stock chart, to be honest. So these are companies that are currently making absolutely no money, but are selling the idea of innovation and things that are concepts that are significantly out into the future. Now, not all of these are going to fail. Some of them will turn into significant businesses. But any line that goes parabolic like that in an industry that you have that companies aren't making any profit, I think there's certainly signs of a little bit of froth there. And we've talked a lot about technical indicators that we've seen that show the market in a little bit of an overbought posture over a short-term time frame. And a few weeks ago, we took the opportunity to take some profits because of that. And quite frankly, that hasn't necessarily been worked off yet, and we're still kind of waiting for that to take place. So yeah, I think there is a fair amount of speculation in the marketplace right now, and I think those charts kind of bearing that out, so to speak.
So Doug, with the speculation and words like mania, I look at this chart and I'm old enough to say, can anybody say the .com, looking at that thing run off the chart? Are these messages, should people be running for the hills if there's manias and bubbles and?
No, I don't think so, because I think, the amount of support you're getting from the Fed and from the fiscal stimulus right now, I think has put a little bit of I don't want to say a floor under the market, but the kind of bear market situation, or the type of trading that we saw after the tech bubble burst, so to speak. It's hard to envision a drawdown like that with that level of support. And some of the names that have been running significantly over the past year are still decent companies. You have your Facebooks, your Amazons. These companies generate a ton of cash, your Googles. So I think during the tech bubble, almost all those companies were wildly overvalued. Most of them didn't make anything. Whereas here, I think it's a better mix. The other thing I would say is that not every part of the market is suffering from this type of speculation. I think a lot of the value sectors, energy, financials, industrials, materials, some of the cyclical stuff that is more economically sensitive, you're not seeing that level of speculation there. And I think those assets have shown some good growth recently, but they're probably still fairly valued to slightly overvalued. So it's always hard to time things like that as well. Most corrections, don't, the saying that we've used before, every 20% bear market started as a 5% correction, but not every 5% correction turns into a bear market. And that's important to remember. So, I think you get to a point where there's signposts that kind of say, okay, things are really starting to turn from correction to problems. But I think to kind of front run that is a tough proposition, so to speak.
So the Fed has seemed to indicate a willingness. They have some objectives, two primary ones. One, obviously, dealing with employment, another dealing with inflation. We have a long way to go with the unemployment rate. Is some of the charts you've shown us, indicate where we've made a lot of progress from the bottom, but we've got a long way to go. And with inflation, they've seemed to indicate that they're willing to let things run hot for a while in order to make sure we're on solid footing. With that said, and words like mania and some of these extremes we've seen, what would be, and let me just say at the beginning, we absolutely regularly tell people we can't predict the future, but understanding what markets typically do, what would not surprise you in the way of market volatility going forward, and you think would allow us to sort of keep our base case recovery scenario even for these select equity groups that we've already talked about?
So I think, going back to the beginning of the presentation, I think that the trends in COVID are an important aspect of that. I mean, that kind of holds the key to everything else being able to function properly, so to speak. And I think that if you didn't get any indication from the Fed that there was any kind of tightening on the way, or if the stimulus package wasn't, a complete bust, I think everything that we see now would lead us to believe that you're going to see some volatility over the next few months, just because the path that we're on is probably not sustainable, at least in its current trajectory. So the two ways that you get that to work itself off are through a price correction, which is exactly what it sounds like, where the price is correct and move lower by anywhere from 5 to 15%. Or you see something called a price consolidation, where the market just moves sideways over the course of weeks or months, and doesn't necessarily have to fall off a cliff, but some of that excess is kind of worked off over time, so to speak. So I think that normal volatility is healthy, and it's part of markets, and I think sometimes we forget that because we've been through a time frame where we've had very little of it, even before COVID started. 2019, same situation at the very beginning of the year. We just had so many days where we didn't have big volatility moves, and then all of a sudden a few happened out of nowhere, and it kind of took everybody by surprise, so to speak. So I think volatility can be a good thing, and I think in this over the next few weeks, if we see things settle down a little bit, I think it will probably present an opportunity, as long as we don't have any of those other things in terms of COVID and stimulus fall apart. Okay. So we're kind of butting up against time here, but I wanted to get to one or two of these questions that came in. One was kind of, as we see the speculation aspect of things, and if we wanted to make kind of adjustments to portfolios, what would be the best way to add asset classes to that? Would it be things like gold, Bitcoin, cash, real estate? What assets would look the best there? I think in a situation like this, you're probably, and this certainly isn't a recommendation to raise a large amount of cash unless you're really uncomfortable with the situation. But, cash and long-term treasuries are normally going to be your best hedge against equity volatility. A lot of times we think gold is, but gold is kind of more tied to the concept of real yields and real rates. So even though we've had inflation pressures come up, you haven't really seen the price of gold go up substantially. Cryptocurrencies, again, I think you're in between the world of some functionality, some institutional adoption, and then also some speculation there. So I wouldn't necessarily expect those to be a safe haven, so to speak, in a time of sell-off, so to speak. So yeah, I'd always recommend going to the normal cash and longer term quality bonds there if you're looking for a safe place to run, so to speak. And then one more that we had come in, kind of a question about where we are in terms of our positioning with regards to both value, small cap, and international. We've touched on those themes a lot, and I've even described them as clients in almost sections, so to speak. So if we think about where we are in terms of our value positioning, I would say we're pretty comfortable with that. It's probably our largest overweight right now. When we look at small cap, we've added a small position in small cap. I think in an ideal world, we could add some more, but with the trajectory and price movement of small cap recently, we'd just like to see that settle down a little bit. We think it's gotten a little bit ahead of itself, and any kind of pullback, I think, would offer the opportunity to possibly increase those small cap allocations a little bit. And then finally, international. International has also performed well, and we've had a standing allocation to international. It kind of falls into the small cap camp where we'd like to see a little bit of a pullback, so to speak. Kind of a better entry point. But we do think there are opportunities in places like emerging markets, specifically where the economies that the vaccine is going to have a bigger impact because the health care infrastructure isn't quite as robust as in the US. And then if we have a dollar that continues to weaken in the face of stimulus and inflation, that would certainly provide a headwind to those assets. So those are the themes that we've started to add to. We're probably not fully where we want to be with them, with the expectation that once we get the opportunity that we expect over the next few weeks or months, we'll certainly look to add to those areas when we get the chance. So I know, Mike, we've kind of run over right now, so I'll go ahead and throw it back to you, and we can wrap this up.
All righty. Thank you, Doug. And thanks everybody for participating in our call today. Unless news breaks between now and then, our next call will either be March 11th or March 18th. Those are both Thursdays. We always try and do these on a Thursday. We're just looking at some internal scheduling to pick the date. So you'll be notified of that well in advance. As always, if you have any questions, as I said at the outset, if you'd like slides, transcripts, things of that nature, let us know, and we will get those to you. If you know anybody that needs our help, let us know. We'll help any way that we can. There are no strings attached to that. And I think that does it. Thanks, everybody. Thanks for joining us. Bye-bye.